everyone. Thank you for attending our webinar series today. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group here in Texas. In today's webinar series, we're going to talk about some important issues related to the retirement process for ExxonMobil employees and the environment that we're in today. Specifically, some opportunities that we see for retirees and potentially those that are leaving ExxonMobil in the not so distant future. For those of you who are not familiar with our company, the Retirement Group is an independent financial planning organization that specializes in working with corporate employees, ExxonMobil being one of the companies whose plans we specialize in, and helping those folks to plan for retirement, to successfully transition into retirement, and to manage assets throughout the rest of their life after they leave ExxonMobil and some of the other companies that we help folks with through their retirement. We have a whole host of complementary services we encourage you to take advantage of as you approach your transition from ExxonMobil. And keep in mind that our company is not endorsed by ExxonMobil or affiliated in any way with ExxonMobil, nor are we affiliated with Voya or Ernst & Young. In fact, the Retirement Group uses Charles Schwab as a custodian, so if you and your spouse decide after you leave ExxonMobil to work with a financial advisory firm, we hope that you consider doing some business with our company and have been doing so for over 30 years. People in similar situations as yourself, helping people manage investments, manage their income stream in retirement, the tax strategies that go along with that, and putting a plan together ahead of time, which we strongly encourage you to do. We'll give you some resources at the end of today's webinar series in the event that you would like to spend some time with us. We also have a LinkedIn page we encourage you to follow if you're not doing so already, where we will publish these live webinars as we record them, and you can reference them back, look at different topics that might be of interest to you, and we cover all sorts of topics, some of them specific to the ExxonMobil retirement process, and some of them generic to retirement and tax planning. Strongly encourage you to peruse that at your leisure when you have some time, especially for the topics that are of interest to you. So, developing a plan becomes part of our biggest objective and our commitment to the folks that we talk to, even the folks that aren't clients of ours yet. And we like to develop this checklist for a comfortable retirement. It starts at the very top of the list with emotions, understanding that emotions that drive our decision making and oftentimes will drive us to improper decision making or decisions that aren't in our long-term best interests. For instance, I had some clients that were worried about the future of the company when ExxonMobil stock was below $40 a share, and thought that maybe it was a good idea to sell some of their stock and diversify into some other areas. Also have clients that now are feeling very good about the stock, where the stock is close to $115 a share now. You know, it's more than doubled in the last 16 to 18 months. And this would be an example of allowing emotions to drive our decision making. Another example of this is the timing of our retirement. Oftentimes we see people retiring when it's popular to do so. Maybe they saw that interest rates have gone up or will be going up, and in an effort to avoid losses on their pension lump sum, and as a result of many of their coworkers retiring at the same time, make a decision to retire that's not based on a good and well thought out plan based on their own circumstances. So we strongly encourage people to take advantage of one of the complementary resources we have available, which is a retirement cash flow analysis, in an effort to identify when is the optimal time for you to leave the company, given some assumptions about the future, some very conservative assumptions. And it will help you in most cases remove some of the emotions from this decision-making process when we are purely looking at numbers, looking at the dollars and cents and the different financial implications of different decisions, the timing, the taxes, the investments, the obligations that you'll have after you leave ExxonMobil, and balancing and weighing all of these out so that you can make a well thought out decision, which in most cases is an irrevocable one, to leave ExxonMobil and either retire for good or maybe go somewhere else in the workforce. Ultimately, we want to remove as much as possible the risk in retirement. What are those risks? The biggest one that most people are concerned about is running out of money or outliving their assets. So it's certainly a big one on our minds as well at the retirement group. But there's other risks, and most of them are just contributing to the probability of that particular risk. Inflation risk, tax and political risk. We have risk of health insurance or health care needs in retirement, unexpected expenses coming up as a result of our physical and mental health. Family risks. There's all sorts of different risks that we want to be prepared for so that when they come around, we're not shocked by them and to a point where we can't pivot our retirement plan. But we want to build a conservative enough plan that we feel confident will give us some flexibility, some room for error, or what we call as value investors, a margin of safety from unpredictability of the future. Maximizing retirement income is a very big objective for most people that we talk to, is just giving us the healthiest retirement paycheck possible while maintaining sustainability or not increasing our risk of running out of money. And that, again, is helped by the cash flow analysis. If we can put together the numbers and make various conservative assumptions about the future, we can have some confidence that leaving the payroll this is a good time to do so, given all of the circumstances that we have and all these variables throughout the rest of our life after we leave ExxonMobil. Taxes are a very big deal. Very small mistakes when it comes to taxes can make or break a retirement. A small mistake could cost you hundreds of thousands of dollars in your retirement plan. So really intimately understanding the tax rules and understanding what you can do legally to preserve your wealth while still paying your fair share in taxes becomes critical throughout this planning process. And then ultimately developing a philosophy about your retirement, whether you're working with an advisory firm like the Retirement Group, whether you're doing all this on your own or something in between. It becomes really important to understand what is important about retirement to you and your family, and ultimately how do we meet those objectives through being financially independent, being that point where we no longer need a paycheck from ExxonMobil or need to rely on the government to be able to meet our goals and objectives in retirement. And oftentimes people aren't comfortable leaving the workforce until they have truly and effectively developed that philosophy. So starting to think about what that next phase looks like for you, we found is really important from a psychological perspective as you approach this transition. There's some key changes in this environment that we're in here in 2023. We've seen fairly tumultuous last couple of years. A lot of changes to the inflation rates and price stability in our economy. Changes to tax rules that we've seen recently, and probably will see continued changes in the coming several years. We saw changes, pretty wild changes in the ExxonMobil stock price over the last couple of years. And we've seen some of the quickest interest rate increases that we've seen in about 3 decades, which of course affects your lump sum payout on your ExxonMobil pension. Now, today we're going to talk about some of the interest rate changes, what the most recent rates are, and how some of these timing issues affect employees differently. We're going to talk about real estate as an asset for retirees, the impacts of inflation on not only your pension, but also your 401k, and then also what are some of these big mistakes and how do we avoid them by using an investment team? Now, when we build this retirement plan, our cash flow analysis that you've heard me mention a couple times now, we're looking at all resources. Social Security is a big one for a lot of families. For some families, or in fact many families in the United States, that's the only income source that they have. Unfortunately, that's hardly a livable wage, especially anymore. So we develop these other resources such as the pension plan, whether you take it as a lump sum or as an annuity, which will be a function of your circumstances, life expectancy, risk tolerance, cash flow need at various points, your tax bracket status, your age when you leave the company, a lot of variables in figuring out what's likely the best option to take on the pension. The 401k plan, where you'll have more flexibility after you leave the company and how you invest it. While you're still working, it's not as flexible in not only what can you invest in, but how you can move those funds. And you gain a lot of flexibility once you leave. That is ultimately what we've helped most employees with, at the very least, is the 401k plan after they leave the company, and protecting and growing that money like it needs to last the rest of their lives. And sometimes the pension as well, if they take a portion or all of it as a lump sum. But don't forget that your real estate, if you own your home, the equity that you have in that home is an asset. And we'll talk about the real estate market a little bit today and using real estate as an asset what we've seen with our clients who have left ExxonMobil and in some cases moved or changed their plans, their living circumstances after they leave the company. So first, let's talk about the pension plan. Many of you know interest rates affect your lump sum. When interest rates go up, the lump sum goes down. They change these rates quarterly, and we saw rates go up pretty dramatically in this last year to where some people that are still working at the company saw close to a 35% reduction on their lump sum. Now, this relationship is also a function of your age. The younger you are, the more severe an impact interest rates are going to have on your lump sum. In fact, it's usually about an 8 to 12% drop in your lump sum for every 1% increase to rates, depending on your age. Now let's look at the current rates. I'm going to zoom in because this table is a little bit small. You can see here we have at the top of the table the December and November corporate bond interest rates, first segment, second segment, and third segment rate. The company takes the average of these 2 months, which happen to be the fourth and fifth month prior to the second quarter. And they get these blended rates, which we've called here the Q2 2023 blended rate. So anybody who retires and takes their pension, commences their benefit, in the second quarter of 2023 will be using these blended rates here that were based off December and November of last year. The reason this is significant is because it gives us a bit of a crystal ball as to where interest rates are going and whether or not we should leave and take our pension now, or at least consider that in an effort to avoid losing money on our lump sum because we know interest rates are going up. Now we've also, for reference, given some previous quarters. You can see quarter 1 2023, which as it turns out was based off of September and August. Those interest rates were lower on all 3 segments, meaning that most people will be losing money going into the second quarter on their lump sum. How much is going to be, like we talked about earlier, a function of your age and also how long you've been at the company. But we focus mostly on this second segment rate, which is intermediate corporate bond interest rates. You could see from the first quarter to the second quarter, that's going up about 44 basis points, 0.44%, which is probably close to a 4.5% drop on a pension plan, at least relevant to this segment. The first and second segment changed in a little bit different amounts, but the second segment rate carries the most weight. Now, for some of you, that may not be that substantial depending on your salary. If you're making $200,000 a year, or what is $50,000 a quarter, and then losing, let's say, $25,000 from quarter to quarter on your lump sum, that might not be as painful as somebody who's losing the same amount in their pension as they're gaining in their salary. That might be somebody, especially if they're close to retirement anyway, who considers leaving before the end of the first quarter to lock in the first quarter interest rate and avoid tens of thousands of dollars in losses potentially on their lump sum. Now, off to the right here, I won't talk too much about this because there's very few, I would say less than 1% of the ExxonMobil community is classified as grandfathered. But the rates that they used to use, and some employees are still using, are based on the 30-year Treasury interest rate, and those interest rates went up 75 basis points, 0.75%, which might mean closer to 7.5% reduction on lump sums for this employee. Now, those folks are getting up there in age, and eventually there won't be any more grandfathered employees, so the impact might not be as severe for them because the older you are, the less significant interest rate increase of an impact it has on your lump sum. However, both of these need to be understood, especially for somebody who's really close to retirement, because it could mean, like one of my clients saved, I think it was $80,000, what she would have otherwise lost by not retiring when she did. And she was close to retirement anyway, so that was an easy decision for her to save $80,000, essentially not have to work that whole next quarter and make more money than she would have had she stayed at the company. So pretty important to understand, if you're not as familiar, how to run your pension projections on the ExxonMobil website or through the EDA website. Let us know. We're happy to walk you through that process and give you some insight on what variables you might want to consider using when you're projecting future retirement dates in terms of what are the interest rates doing, and also educating you on how the annuity options work as well, because the lump sum is not appropriate for everybody. And especially now with interest rates higher, we see more and more people taking, or at least considering taking, the hybrid option, where they take part of their pension as a lump sum and part of their pension as one of the various monthly annuity options. One of the other opportunities that we're seeing now is with real estate, and there's some key housing market data that has created short-term opportunity for retirees that are considering downsizing. A lot of my clients, although most of them don't downsize immediately when they retire, eventually most retirees downsize because they don't want to take care of as big of a house, or they don't want to take care of as big of a yard, or they want to move to where their kids and grandkids moved, or they want to move. I just talked to a gentleman that asked me to do some research for him on 55 and up retirement communities, so he can be living in an area that has people around his age. So a lot of reasons, and the most obvious one from a financial perspective is getting money out of the equity in your home, if it makes sense to do so. If you could downsize, either you can afford a nicer place or afford a smaller place that's just as nice, but then have some money to do some other things with. Now is a great time to be doing that. And while a lot of this data for the housing market is suggesting that we still are undersupplied on the amount of houses that we need here in the United States, which is drastically different than where we were in 2007 with the housing market bubble and then eventual crash that hurt many people's equity in their homes or the value of their real estate. So because of this, we want to consider real estate as an asset. We also want to be cognizant of the debt and utilizing debt potentially to our benefit. I have another client today that is looking to buy land, build on the land, and one thing that she also asked me today is, does it make sense to pay off their boat this year? Well, given that they're going to need money to purchase the land, they're going to need at least a down payment, maybe even more if they decide to pay cash for the construction of their home. Probably not the best year to be paying off debt. And what we found out is her boat and her car were less than 4% interest rate, which I happen to tell her was a pretty good deal compared to what she could get this year in 2023. So maybe we want to defer that decision to next year. Understanding how that plays into your overall retirement plan, especially the tax implications of that, is critical in developing a well thought out retirement distribution strategy that allows you to pay as little taxes as possible and keep your money as long as you possibly can. And inputting real estate and asset is very important, especially today in the market that we're in. Now, we've also had some of the highest inflation numbers in 40 years last year. We clocked in close to 9% year over year inflation during the middle of the year. Looks like those numbers have come down a little bit, and it looks as if the efforts of the Federal Reserve are starting to have some impact in reducing inflation and controlling prices in the economy. But unfortunately, inflation has other impacts than just increasing our cost of living. Inflation historically has been attached or correlated with interest rates. This is just another example of this recent environment we've been in, where inflation's gotten higher, so interest rates have gone up. That has decimated the value of a lot of people's lump sums on their pension, those that weren't able to, whether they couldn't afford to or just weren't ready to leave ExxonMobil by last year. It's very possible these rates continue to go up, and those of you, even though you may have lost some money in your lump sum already, doesn't mean the lump sum should be off the table as an option for your pension plan, but we also want to understand the annuity options because they could make some sense. One of the silver linings here, though, is fixed income investments like bonds, money market CDs. These have always been an important part of a retirement portfolio, and they're paying substantially more now than they have been for quite some time. Substantially more certainly than they were even just a year ago. So while your pension lump sums may be lower, your ability to generate yield in your retirement portfolio has gotten a lot easier with higher interest rates in this last year, making the lump sum still potentially attractive just on that fact alone. Now, one thing that some of you also probably suffered, especially if you have long-term bonds in your retirement portfolio, whether it's the bond units that are in your Voya 401k or some bond mutual fund or bond holdings you have outside the 401k those probably also got hit last year, because when interest rates go up, just like your lump sum goes down, so too do bond prices. Now, while those bonds might be paying you more, it might take a while to make back what you lost in a very short period of time, as interest rates went up really quickly last year. So understanding the importance of having fixed income investments like bonds in a retirement portfolio, but also the risks of those investments, is critical in an environment that we're in right now. It's high inflation environment and rising interest rate environment, where many of you that were around in the late 70s and early 80s know that we're not even close to where we were in terms of interest rates back then, and it's still possible, in an effort to get inflation numbers back down to where they want them to be, which is somewhere between 2 and 3% a year, it might take some further interest rate hikes. Now, there's a lot of mistakes that we come across in working with ExxonMobil employees, like we've done for about 30 years. I personally have been with this company about 12 years, the retirement group. And we feel that we've seen every mistake in the book, although I'm sure that we'll find another one that is new at some point. But some of the biggest mistakes that we find people making, me personally, is folks waiting until way too late to start their planning process. It becomes a very stressful process, and that's typically when decisions are made poorly, is when they're under duress. So strongly encourage people, get a head start on this. It's completely complimentary to talk to us. That cash flow analysis I mentioned earlier is a complimentary service. Worst case scenario, even if you don't do any business with us, chances are you'll probably help us grow our business by recommending some of your coworkers talk to us, as we feel very confident we know your ExxonMobil retirement strategies better than anybody out there. And if you decide to work with an advisory firm, we think that we have a pretty good value proposition in that we've been helping people for over 30 years. And we have references of people that are in the same situation as yourself, that have had a successful transition and that are still clients of ours decades later in some cases, that we encourage you to at least spend a few minutes with us and talk to several different groups. Although we are very confident we're a pretty good option, doesn't mean we're going to be the best fit for you and your family. And what I recommend is talking to at least 2, but probably 3 different companies to see who's the best fit from both a cost perspective, relational perspective. You might get along with somebody else better than you get along with me, or you might have a different vision for your retirement. The rapport might not be there. Those are pretty important things in our opinion for somebody that you may be talking to many times per year for potentially the rest of your life. The advice has got to be there. Track record of performance and success should be there. They should offer a complimentary and detailed financial plan, and they ought to understand your ExxonMobil benefits, given that there's plenty of companies out there that have some clients from ExxonMobil, and we just happen to be one of them. So schedule meetings with a couple different groups, and those are some good questions to ask. What are the costs? What are the reasons your clients like working with you? Maybe what are the reasons that clients have left your company or didn't like working with you? That's probably a difficult question to answer, but an important one, I would say. And what's the frequency, or what is your commitments to me and our family? What's the frequency of communication? How often are we going to review the accounts as well as update our plan? Those are some of the things you probably want to understand ahead of time before entrusting somebody with potentially your entire life savings, or at least a portion of something as sacred as your retirement assets. Unfortunately, statistically, 74% of Americans over the age of 50 do not have a written plan for their retirement. And as far as we're concerned, this is unacceptable, folks, especially since a number of companies are willing to do this for you on a complimentary basis. Please take advantage of this. Give us a call if you haven't done so yet in order to run one of these plans, or if it's been over a year since we've updated your plan, let us know so we can get it updated with all the changes that we saw. You can get in touch with us by emailing us at info@theretirementgroup.com. You can call us at the home office at 800-900-5867. You can also schedule a call through this QR code. Take a picture of it. It'll get you a link to a website where you can get on mine or a number of my colleagues' calendars. And again, here's the QR code for our LinkedIn page where we publish content specific to the ExxonMobil retirement strategies. With that, we're done with the presentation today, but we did have some questions come up this week. I'm going to go through a few of them because it looks like we do have a bit more time. First question, can my pension be adjusted by ExxonMobil to account for inflation? I've been with ExxonMobil 26 years, and my lump sum option is grandfathered. To my knowledge, ExxonMobil has never given a cost of living adjustment for existing recipients of their annuity. Where a lot of people, one of the biggest reasons I've seen people taking the lump sum recently, even after rates have gone up, is because of a concern for future inflation. Whereas they felt that the lump sum was better, it was going to be a better hedge against inflation because they can invest in stocks and investments that will actually grow in inflationary environments. Whereas the annuity option does not. So unfortunately, unless ExxonMobil has some program in the future to increase their beneficiaries, annuity beneficiary recipients' pensions, which I don't think is likely, no, that's not an option they've ever taken to my knowledge. Question 2, my coworker left in order to lock in lower rates. Can you explain why this makes sense for grandfathered employees? Well, like we saw in the earlier slide, grandfathered employees' interest rates are going up 75 basis points, which might mean a loss of 7.5% overnight to their lump sum, depending on their age. So if you don't, you have to be retired to take your pension, of course, and then you also have to commence your benefit, which is fill out all your paperwork correctly in good order. And as long as that commencement date is within the quarter, which also has different rules, whether or not you're grandfathered employees can commence their benefit at the end of the quarter, whereas non-grandfathered employees have to actually leave 1 month earlier to get an effective commencement date in the current quarter. Very, very critical that you get this right. This is what this individual is asking about, is why it might make sense for a grandfathered employee, but it's all employees. It's not just grandfathered employees that are going to be losing money in the next quarter, and we may continue to see this in future quarters, which is why anybody who's close to retirement or might have a job available outside of ExxonMobil at a different company, or even contracting back to ExxonMobil, needs to be looking at this as an option to not only lock in the lump sum now, but also, big benefit a lot of people forget to realize is the ability to invest that money. There's an opportunity cost to staying at ExxonMobil, and the opportunity cost is whatever rate of interest you're comfortable you could earn on that money if it was in an IRA or if you had rolled it over to an account like your 401k after you left the company. All right, another question. I read an article about using my pension to buy an annuity rather than taking an annuity from ExxonMobil. Can you tell me if this makes sense? Not unless I know more about your situation. It's certainly possible this could make sense to you, but there's a lot of features of annuities, and some of those features will be more or less attractive depending on the individual. So features such as cash value, or the ability to take more than the allotted monthly income that the ExxonMobil pension annuity would otherwise give you. Death benefit, if you don't spend all the money your kids, grandkids, spouse, cause that's important to you, could get those assets in a private annuity, as I call it, a non-ExxonMobil pension annuity. Whereas your ExxonMobil pension, that's for your life and maybe some additional benefits if you take the period certain or the joint annuity, but then that's it. So more flexibility on death benefit potentially. Inflation hedge, a lot of annuities will be somehow correlated to the stock market or even fixed income markets in some cases, which could create a better inflation hedge. But there's always going to be costs in a private annuity that you're probably not going to have, or you're definitely not going to have in your ExxonMobil pension. All of those need to be weighed. And what I've seen a lot of people do is take the lump sum on their pension and then just use a portion of it to invest in some type of an annuity, whether it was an annuity that was built for income, lifetime income, or a certain period of years of income, or whether it was built for something like principal protection with a growth opportunity, which a lot of people, especially lately, have been more interested in than a lifetime income stream. All of those need to be reviewed with a professional, a group hopefully that understands retirement investments intimately, to help you identify what potential benefits there could be on a private annuity compared to the annuity option you have available through the company. All right, last question here. I heard that RMD age is changing. If I am 72, do I need to take a distribution this year or next year? Great question. They did change the RMD age. It's now 73, the year that you have to start taking money out of your retirement accounts and you have to start paying taxes. unless you want to pay a 50% penalty for the money that you don't take out that you're supposed to. If you turned 72 last year or earlier, then you were supposed to take money out by the end of last year, although the first year that this happens, they give you until April 1st of the following year, which is called the required beginning date. Oftentimes it doesn't make sense to utilize that though, because if you wait till the year after you turn 72 for this individual to take money out for an RMD, you're going to have 2 RMDs that first year, which might be more income than you want to be taxed on. So oftentimes it makes sense just to take your first RMD prior to the end of the year that you turn 72. However, like he mentioned, the rules change. So if you turn 72 this year in 2023, you actually don't have to take money out until next year when you turn 73, or by April 1st of the following year in 2024. And as it turns out, that age is actually going to increase to 75 down the road. All of these are benefits in giving you more flexibility to wait to take money out of your IRA. You can take it out as soon as 59 and a half without penalty, and as much as you want at that point, but it's at 73 now that you have to start taking money out. And something that you may want to be preparing for and doing something like a Roth conversion we do with a lot of our clients prior to age now 73, in an effort to protect more and more of their money from the federal government, so they're not forced into a much higher tax bracket once they turn, which was 72 and now 73, later into their retirement years. That's all the time we have for today and all the questions. Thank you everybody who asked questions and attended our webinar series today. We hope you all have a good, safe rest of your week, and we hope to talk to everybody very soon. Thanks again.